As a value investor, one of the most important topics, of course, is valuation. And I was so pleased to hear Michael's comments about Lou Simpson, because I remember the story told at Geico about Lou when he was making the transition from tennis shoes investments, which of course were the great star of his portfolio. First in Reebok, he was moving to Nike, and he had his team do all the research. And there's one outstanding issue. They resolved that issue. And one of the participants said that after resolving the issue, Lou said to him, go tell the trader to buy Nike. And he said, how much should I tell him to buy it? What price? He said, just tell him to buy it. Just buy Nike. And he bought Nike, and he bought Nike, and every day they buy Nike. They had a huge impact on the share price. And Lou, in his appetite for concentrated returns, didn't flinch whatsoever. And I was told this story years later, and split adjusted, and with the fullness of time, you look at it, and the difference was between, say, $3 and $3.12 on a stock that by then had gone into the $60 or $70 in valuation. The difference between holding for a little bit extra and having that position perform so well would have been lost if they had held on overly narrow valuation description. So. As far as the people who I've not met before, my firm is a global value equity investment firm, started in business after Stanford Business and Law School. I had the great fortune at business school of meeting Warren Buffett in 1982, and he really left three impressions. The first, he suggested that the investor only has one grant from the government. The U.S. government allows for the deferral of non-realized gains. That's an advantage you should take advantage of, and it means that you have to buy to hold. Buffett talked to our class in 1982. Prior to that, he would have been famous for being a 50-cent dollar bill investor, and by the time we met him, he had already bought See's chocolate, and his world was changing. I mean, See's has a brand, he could price and he could develop the business, and he never had to sell it. If you think about that investment, he spoke about it recently, he may have paid $30 million for it. It's spun off since he bought it $2.9 billion. Today it's probably worth close to $2 billion if you think of its valuation relative to Russell Stover. And he never had to do anything but maintain pricing discipline in the business, and it grew over all those years. He never paid a penny of tax on the investment, and it's so much more productive than trying to find 50-cent dollar bills, which don't exist in size anymore. And even if you find them, your return is so time dependent. The beauty of a See's is that it's growing along the way, its intrinsic value, and you can be very patient with it, knowing that your market value will be pulled along by the increase in the growth of its intrinsic value. So that was the first thing. The government gives you one break, you should probably focus on that. The second one was you can't make a good deal with a bad person. That has to do entirely with agency costs. And if there's one theme that's gone through Berkshire Hathaway's investment over the time, has been the migration away from companies, purely public companies with standard management structures, to businesses that are family controlled, and businesses that have the benefit of having a long-term frame of reference. Agency costs, the opportunity for management to take from you, the owner, is very, very risky. It corrupts most public companies, and there are very few that offer you the ability to align your interests with the management. And so Warren suggested that you pay attention for businesses that have low agency costs. It ends up being, in his case, in most of our positions, a family control screen in some ways, because the families have dynastic views, and if you find the right family and partner with them, the ability to sustain the first goal, which is not to sell stocks, becomes higher because the family has the same alignment as you have. So in our portfolio, for example, over 65% of our companies are still controlled by family owners. It's a very high number. I don't think you'd find that most anywhere else. The benefit of it is that family control often comes at a discount in the open market because most investors wrongly think professional managers are really professional, and they worry about the family bickering and family dynamics of a family-controlled company. And so you get the improper allocation of valuation is if you can get the alignment of interest that comes from a thoughtful family. Now, the great example of that, the mother of all examples, is Berkshire. And so it really is just an extension of the kind of extraordinary ride investors who have been around Berkshire for a while have experienced because of that extraordinary alignment of interest. The other thing that Warren said, which was quite interesting, he said, through his own endeavors, the ability to do nothing is massively undervalued. Berkshire may do nothing for years and just build on cash, and we, by contrast, are fully invested almost all the time, but we do very little. I think someone ran our past 4 years of portfolio turnover. I think the number was 2.5% or something. We just find business that we're quite comfortable about, management, growth prospects, reinvestment prospects, and we have the discipline to hold them. And I think it's a blend of stubbornness and also an investment clientele base that we've disciplined in knowing that though we show up to work, we don't show much work when we show up for work. Anyways, if I can advance this, here, this quick run through. The first slide here, this is the notion of a long-term buy and hold investor. So in 2008, during the crash, my family had gone on a safari, and as we were going out every morning, break of dawn, looking for fierce animals, I would call in the office and stocks were plunging. And we'd go and find different animals. And every time we see an animal, the guide would say, this is an animal, ferocious as it is. If it charges you and you're away from the group, stand perfectly still, and it'll run right past you because it really chases after movement. So just stand still. He said that about every animal we'd see, whether it's a chameleon or a lizard or an elephant or anything at all. We saw that one at some point, and he said, that's the Cape buffalo. If you're ever separated from the group and it comes charging at you, run like hell. Trouble is, from a distance, you can't really tell. And that's the problem with investing. We were told always, buy portfolios and hold them through thick and thin. And in 2008, I wasn't sure whether it was a Cape buffalo. Luckily, I was on vacation and far enough away from the desk that I didn't sell out, but it could have been such a moment. The other thing that Buffett says, and I think it's true, that the investment business is as simple as Aesop's fable, where basically, that's the next slide, what you're doing is you're giving up something today. The most profound lesson in investing is you have to give up something today if you want more later. And Warren says it's as simple as that, and it's as tough as that, because you really only know one thing in that equation, which is what you've got. And to be willing to forego it for something later presumes that you'll know when and how many. Extremely hard to know, so you want to find investments where you can increase the odds that by giving up something today, you'll have more later. And that has to do ultimately with organic reinvestment. The best businesses are those that have the capacity to reinvest internally, so you increase the odds that what you give up will come back later in many more units over time. In the concept of alignment of interest and agency costs, culture, corporate culture becomes extremely important. This slide was borrowed from a Nestle presentation. I can't get through a presentation without talking about Nestle, but a Nestle presentation where the CFO referred to that slide, and he had been the head of Japan, and he said he liked the slide because that temple was 700 years old. He said, none of the wood in that temple is 700 years old, but the temple is. And what that suggests is that a culture of a firm, obviously, is expressed through people over time. I'm now on my 4th CEO at Nestle. He says the same thing that the first one said, 30 years ago when I first invested in Nestle shares. And I hope he'll say the same thing with the same commitment to balancing the near-term versus the future returns. When I meet the CEO, who will be the 8th CEO I've had at Nestle, God willing. So anyways, the notion of conflict of interest, value investing sort of version 1982 Stanford Business School, avoid conflict of interest, and seek alignment of interest, and the capacity to reinvest. Well, that's really what happens then. If you want to buy something you don't have to sell to avoid taxation, the business has to have the capacity for reinvestment. For me, the area I derived to focus on is consumer brands, global consumer brands. A consumer brand is all about a business that has price inelastic demand. The consumer doesn't think there's an adequate substitute for the brand that they cherish, giving you both the regularity of demand and also pricing power if you need to raise prices to cover cost of goods sold inflation. And so global brands is the area that I found to be of interest, and much like what Warren had with See's. We've only had it in other businesses. In fact, today, one of the companies that I once owned 20% of, called Weetabix, is in the news again because it's being sold by the Chinese who ended up buying it from Burton Latimer in England. And it's being sold for 1.5 billion pounds. It was acquired from us for 800 million pounds in 2003. I mean, it's a perfect brand. The cereal is inedible. It did lack, however, capacity to grow because as much as they tried to take it around the world, the only place they found could eat it was Canada. You have in Clinton, Canada, you have a nice Weetabix factory. And they did get to the Australian back in the back, they did get the Aussies to eat it, but they misspell it. They call it the Wheat-Bix, I think. But anyways, we once owned 20% of the company. It lacked entirely the ability to reinvest as much as they would like to colonize the world with breakfast cereal. They couldn't do it. So the cash just mounted over the years, and we entered the position at half of its intrinsic value, calculated about 8 times EBITDA at the time, and finally sold it 21 years later at the then sharply accreted intrinsic value on a per share basis. But over that time, they took cash from $16 million in the balance sheets to $120 million because they couldn't reinvest it, and they were smart enough to know not to try. And that was a family-controlled company at the juncture between not having the ability to reinvest and not wanting to squander the cash. They took a very shareholder-minded step and sold the company. What do you need to have the capacity to reinvest? For me, it's been global brands. They respond to population growth and to growth in consumer disposable income. This, by the way, is a story of the last 30 years. I've been doing this for 30 years, and from the start, we've entered into an era of increased globalism, increased trade, borderless trade, global branding, global values, and unfortunately, we're at the sort of breaking point of so many of those factors which have provided my portfolios with such a huge tailwind over the past 30 years, because we have rhetoric against trade, against global brands, against common features around the world. That is something that will threaten our returns if it continues unaddressed. And so consumer disposable income is part of the growth. You see very little of that in Syria today or in Uzbekistan or any number of places that have gone off the rail, and that's ultimately something that will determine our long-term results. What else is helpful? On the personal side, if what we look for in companies that are going to be global, we look for multicultural and multilingual management. So from a multilingual perspective, how many people here speak more than 4 languages? I'm looking. Is there a single hand? So if this were in Vevey and we were at Nestle's headquarters, probably 100 people would raise their hand, and they wouldn't think anything of it. And I admire that immensely. As far as multiculturalism is concerned, how many people here have a favorite cricket player? I mean, this is a Commonwealth country. I'm appalled. So in the United States, there would be no hands up, I can assure you. Anyways, both of those are soft tissue items, but they do affect whether a business has the ability to navigate around the world. So I tend to, my capacity to reinvest has been defined by global brands with international headquarters usually in Europe. The good news about that is investors typically hate that category because European consumerism has such bleak future. But through the companies we own, whether it's Nestle, Heineken, Unilever, Pernod Ricard, any number of them, what we're really trying to get at is a less risky way to reinvest our free cash flow from portfolio companies into the parts of the world that are going to grow. You do it through Unilever, not because they have a great business in England, but because they have an 85% market share in Vietnam, and that market's growing at 12% a year, and they're able to pour capital into that market at high rates of return. You own Heineken not because of the Dutch market, which has the indignity of giving Heineken in red label bottles. You buy it because they happen to have the largest presence in Vietnam for beer, which is surprisingly the second most profitable market in the world for Heineken. It didn't even exist for Heineken in 1994. The ability to take Dutch profits and develop that kind of commanding presence in Vietnam is worth a fortune. Fortunately, investors typically look at European companies and say, well, you know, Heineken's great in Europe, but who's drinking anything anymore in Europe? It's gone ex-growth. So we, through those businesses, buy them at a discount. We particularly like to buy them at a discount for family control as well. We get a double dislike, and that's usually a good place to start when you're investing. And then the ability to do nothing, I don't have to worry about that. We're perfectly comfortable doing nothing, but Michael was absolutely correct. Doing nothing is very good for investments if you have the right investments, and it's horrible for running a money management firm. We've been 3 years out of step with the markets, and you know, our businesses are terrific. But you know, the urge is to then say, well, maybe I should creep over and get a little bit of the stuff that's working. And of course, that's the thing, the urge to resist. All right, so a couple of examples quickly of businesses where they've done the right thing. How are we doing for time? 10 minutes. Oh, I can do that. Where they've worked well and some where they haven't worked well. Berkshire's obviously the mother lode for capacity to reinvest. One thing I skipped over, because I want to, if anything, when you leave here, to understand it's not just the capacity to reinvest that we look for, it's the capacity of the managements and the companies that do reinvest to suffer badly. They have to have the capacity to suffer, because if they're going to invest the right amount of money, it's likely going to burden near-term profits. That's the old Aesop's fable. You're giving up something today which is robust reported profits, because the investments that will be required to take you to the next level burden reported profits because of the lack of absorption of upfront expenditures when you're trying to advance your market. If you build, I mean, the great story is that Nigeria had 3 Maggi bouillon factories, and they were operating at 140% of capacity and making obscene amounts of money. They put in a 4th factory. They had the capacity to reinvest because the market demanded far more than their existing capacity. Well, they put in a new factory. By the time it was built, it cost $350 million. It was partially used, and so it had horrible margins. And yet it's designed to deliver the kind of margins that the 3 earlier ones had 5 years out or 10 years out. And that notion of having management ability to go into the market and suffer through upfront expenditures with the assurance provided by the family control in most cases that they won't lose their jobs just because they disappoint Wall Street near term, because the families that, like us, are looking for long-term returns. So it's a combination of having the ability to reinvest given by your brands in markets that are growing, with the management's capacity to suffer slings and arrows and all sorts of offenses by Wall Street in their pursuit to get the job done. There are a series of examples in the panel here that I could refer to, but I'll jump ahead to one that's just recently sort of expressing itself, and that's Philip Morris. Philip Morris has had a miserable 4 years. They've been profitable. They've actually grown their profits 12% a year for the last 4 years, but the growth has been masked by currency translation because they happen to be a headquartered U.S.-based company with 100% of their business done abroad. So all the strength of the dollar that you've seen in the past 4 years as the world chased the U.S. indexes has affected the reported profits. So now it's 4 years into 4 years of reporting $4.35 a year, even though each year their profits grow by 12%. So they've had a remarkably difficult time because of currency, but they through that period of time not succumbed to Wall Street's plea for better results through cutting expenditures, cutting advertising, investing less in markets. They've invested straight through it, even though compensation was impacted to management because the shareholder-based compensation is based on comparisons with other companies that didn't suffer the currency so uniquely as Philip Morris did. Throughout this, they invested in something called, so we'll fast forward to this. I think I'm jumping over Nestle and Berkshire to get to Philip Morris. Okay, here it is. They've invested in a product which is a heat not burn, non-combusted cigarette. It delivers 95% of the nicotine that consumers wish when they smoke. It's 19 milligrams of nicotine in the first minute. The prevailing e-cigarettes that attempted to serve a health need deliver 2 milligrams in the first minute. They don't work. The market sort of rested on poor technology. Philip Morris explored brand new technology. They spent $3 billion over 6 years on a platform that they launched. None of their competitors invested anything remotely close to that. All of that investment goes through the income statement, which has already been burdened by foreign currency. But they had the capacity to reinvest, the knowledge of the industry, and the capacity to suffer. Management was permitted to spend that order of magnitude. The business has come through the other side now, and it's in 30 countries. In Japan, where it launched, there are cities where the share now from this product is over 20% of the city. They think it'll be 30% by the end of the year. 2 million smokers have quit smoking as a result of this product. And it was something that they invested without competition. The rest of the industry delighted to be able to show very high near-term returns, unburdened by the kind of investment that the management. Every time I'd see the management, senior management for Philip Morris, they would inevitably ask me, are we suffering enough? And I'd typically say, yeah. They were valiant in those spending. And today, with the pace of absorption, their competitors have nothing to deliver. They're just empty shelves. They reported more income, but they weren't building wealth in the process. It's all about that trade-off between burdening today for something much more later on. The other, great other example is through Berkshire Hathaway. Almost everything Berkshire Hathaway does is advantaged by Warren's willingness to completely disregard reported income. If he takes on finite risk transfers in insurance, it was all about his ability to destroy reported profits. When he took on the $37 billion pool of equities that he sold the protection against, he did so realizing that the mark-to-market would burden his reported income, and it did. In fact, it burdened income to the tune of $12 billion over the 5 quarters that followed writing that policy. He had $5 billion to invest as a result. It was way too much premium that they gave him, and he was, I think, the only one even in the running to write that policy, because no other company in the planet would take on the type of exposure for their income statement that Berkshire gladly took on for the right to invest $5 billion of float, or a premium rather, and not have to make good on his commitment for 18 years. Nobody else in the business would dare take on that kind of burden for the income statement. It's all about sacrificing today. In Warren's case, he has control of the company. It doesn't matter, versus how much more later on. $5 billion that he received in the 2008-9 timeframe will probably be worth $15 billion by the time the whole thing settles. The equity markets are well beyond any obligation for him to make them whole. So sacrifice today, the return later. I'll stop if there are any questions, if I have any time.
We'll come back at the
end. Thank you. Thank you very much.